Hey, how's it going, guys? Welcome back to the Module 4 of Options Trading Foundation, the complete options trading course for beginners. Module 4 is all about the advanced options trading strategies that are suitable for beginners. In this video, the sub-module 4.2, we will cover another very popular option trading strategy called the butterfly. Alright, let's get started. In the previous video, when we talk about the straddles, we mentioned one concept called the delta neutral strategy. A delta neutral strategy means your final profit and loss from your trade will not depend on the underlying stock price directions. In other words, a delta neutral trade allows traders to make money no matter if the underlying stock price goes up or down, as long as it meets some other important market conditions. A straddle allows traders to profit from any underlying stock as long as their prices make a significant move either to the upside or downside. But now the question is, what if you believe the price will not make any significant move for a period of time? Then that's exactly where the butterfly strategy comes into play. So what exactly is a butterfly in options trading? Butterfly is also a delta neutral strategy that combines a bull spread combo and a bear spread combo, which we have discussed back in the module 3, all different types of option spreads combos. And all these spreads involve either all call options or all of them are put options that are used by the traders to create a net for the underlying stock price to move within a range and eventually make profits as long as the stock price does not move out of this butterfly net or the price range. If you are still confused by this super long definition of butterfly strategy, you don't have to worry at all. You will definitely understand it much better after we go through some real examples later on in this video. So, when is the best time to use a butterfly? The best time to use a butterfly trade is when you anticipate the underlying stock will not make any significant price movement in the near future, and the stock will be trading within a clear range over a certain period of time with strong support and resistance levels. It's exactly the opposite to the straddles. You are trying to profit when there's no significant price movement in a stock. Or you can think of it in this way. You take butterfly trade because you're trying to take advantages of a potential range-bound market action. As I mentioned a couple of times in this course, in general, markets only trend 30% of the time, and for the rest of the 70% of the time, they trade in ranges. So there's a lot more money to be made in those ranging markets, and the strategies like a butterfly can do exactly that for you. So in order to use a butterfly strategy, you need to have a solid foundation on technical analysis because you need to be able to identify the strong support and resistance levels in any markets. This is extremely crucial when it comes to trading strategies like the butterfly. There are 5 major types of butterfly trades that traders can use. First, we have the long call butterfly. Basically, it means you simultaneously buy one in the morning call option with a lower strike price, sell 2 at the morning call options, and buy one out of the morning call options with a higher strike price. Then we have the short call butterfly. You sell one in the morning call options with a lower strike, buy 2 at the morning call options, and sell one out of the morning call options with a higher strike. These 2 types of butterfly trade setups are purely using call options. We can also construct them with put options. First, we have the long put butterfly. You buy one out of the morning put option with the lowest strike, sell 2 at the morning put options, and buy one in the morning put options with higher strike. Then we have the short put butterfly. You sell one out of the morning put options, then buy 2 at the morning put options, and sell one in the morning put options. Of course, we can also mix up with both call options and put options to construct a butterfly trade. We call it the iron butterfly. For the iron butterfly, you buy one out of the morning put option, sell one at the morning put option. Then at the same time, you buy one out of the morning call option and sell one at the morning call option. So these are the 5 different setups for the butterfly strategy. In this tutorial, we will mainly focus on the first trade setup, the long call butterfly, because it's the most commonly used type of butterfly trades among traders, and also it's easier for complete beginners to apply. Alright, now let's take a closer look at the more details of a long call butterfly trade. There will be 3 trade legs in total. First, you buy one in the morning call option with a lower strike price, then you sell 2 at the morning call options with the middle strike price. This price should be the same or very close to the current underlying stock price. And at the same time, you buy one out of the morning call options with a higher strike price. So basically, there are only call options, no put options involved. A long call butterfly trade involves both buy and sell options. There are 3 different strike prices in this trade, and they should have the equal difference between the 3 different strike prices. Of course, all these 4 call options should expire at the same time. The buy-sell-buy ratio in the 3 trade legs should be 1 to 2 to 1. Alright, now let's do a case study and see how exactly a long call butterfly can help us in our options trading. Intel is currently traded at $50 per share in October 2020. After a disappointing quarter earnings report and crashing more than 20% on their share price, Intel has been consolidating for the past 1 month, with a very strong support at $40 and a strong resistance at $60. You strongly believe most of the bearish outlooks on Intel have been already priced in, and the stock will be trading within $40 to $60 range over the next 2 months. You want to make some quick profits from this potential short-term ranging market. Then the best way to do it is to use a long call butterfly trade, and this is how it works. First, you buy one December 2020 call option at a $40 strike with the premium at $7.1 per contract. Then, you sell two December 2020 call options at a $50 strike, same price as the current share price, with the premium at $4.4 per contract. And finally, you buy one December 2020 call option at a $60 strike with the premium at $2.8 per contract. Alright, after you complete this entire trade setup, you will have a net debit of $110. The premium from your long calls and short calls will offset each other and cancel each other out. That is how a butterfly trade can significantly reduce your cost. Lower cost means lower risk. Your total risk for this trade is capped at $110 only. Your maximum reward will be your higher strike price minus the middle strike price or the current share price, and then multiplied by 100 and then minus the net debit. After the calculation, we can get the maximum potential profit for this trade is $890. Same as the straddles, Butterfly also has two break-even prices. For the upper break-even price, it's the higher strike minus the net debit divided by 100. For this case, it's $58.9. And for the lower break-even price, it's the lower strike price plus the net debit divided by 100, which is $41.1. Cool, after we calculate all these key numbers, we can now draw the risk graph for this long call butterfly trade. This is how the P&L line looks like for this trade. In fact, pretty much all the butterfly trades, no matter which type you choose, they all look something like this or similar. First, we have our higher strike at $60, middle strike at $50, and the lower strike at $40. Then we have our higher break-even price at $58.9 and the lower break-even price at $41.1. As we can see from this risk graph, as long as the stop price moves between the lower break-even price and the higher break-even price over the next 2 months, your entire trade will be in profits. And you can hit your maximum profits of $890 if the share price closes exactly the same as the current share price $50 per share by the expiration date. On the other hand, if the stop price moves out of these two break-even prices to the either side, your entire trade will be in losses. And if the price closes above the higher strike or closes below the lower strike, your entire trade will hit the maximum loss of $110. So this is how the risk graph for the long call butterfly trade looks like. One of the most important things when it comes to trading the butterfly strategy is how to choose the correct strike prices for your 3 different trade legs. For all the beginners, I share with you guys 3 important rules to follow. As long as you follow the 3 rules, combined with a solid technical analysis, you should be able to find the most suitable strike prices for your butterfly trade. Rule number 1, your lower strike price should always be at or near the support level. This is the price where you believe the stock will not break to the downside. Rule number 2, your higher strike price should always be at or near the resistance level. This is the price where you believe the stock will not break out to the upside. And finally, the rule number 3, the distance between lower to middle strike and higher to middle strike should be the same. Cool, these are the 3 important rules for beginners to follow when you apply butterfly strategies in your options trading. It will definitely take a lot of practice to get used to the trade setups, but these rules will never change. Alright, here's a quick summary of the butterfly strategy. It is a typical delta neutral or market neutral strategy. You basically anticipate the price will be trading in a range with no significant up move or down move in a certain period of time. You will have initial debit out of your account after you pull up a butterfly trade. Both of your maximum risk and the maximum profits will be limited. The reward to risk ratio is rather flexible for butterfly trade. It depends on the implied volatility and the premium of the options. Out of the money, at the money, and the in the money options will all be used to construct a butterfly trade. That is something very special. And the final tip for all the beginners when you trade butterfly is that although you can use either call options or put options to construct a butterfly to achieve basically the same goal, you have to check the premium prices for both of the call options and the put options, and use the ones that can help you lower down your initial cost the most. Always make sure that you are taking the minimum amount of risk to maximize your profits. Alright, that will be the end of this tutorial on the butterfly strategy. In the next video, we'll move on to the sub-module 4.3 and introduce you guys another advanced option strategy called the back spread. If you're new to this channel, my name is Vic. I hope you guys enjoying the course so far. If you find my contents have been valuable to you, please consider subscribing. Again, thanks so much for watching, guys, and I'll see you guys in the next one. Bye for now.